What is going on, traders? Welcome back to the Traveling Trader. So something happened in the macroeconomic picture that on the surface you would think is good news, but is actually bad news as it relates to the stock market. Last week, the jobs report for July came out, and it looks like the US economy added 528,000 jobs in July. Now, the economists that track this stuff were expecting 250,000 jobs, so we more than doubled that expectation. And the average monthly jobs gain over the last 4 months is 388,000 jobs. So this handily beats expectations as well. So why is this important? What does this mean for the recession picture? And why is this negative for the stock market, even though on its surface it looks like a positive number? Now, obviously for American citizenry, it's a positive thing because we want as many people working as possible. But this is a stock market channel, so I'm here to bring you the stock market news. We will also look at a very strong historical data point that shows why the S&P 500 can actually see another leg down. And I'll tell you what potential option plays I'm looking at to hedge my portfolio based on this data. So welcome to the Traveling Trader, your source for concise, non-BS, accurate market updates. I'm here to break it down all for you. Let's get right into it. So as we stated at the outset, the US labor market continues its hot streak, adding more than 528,000 jobs in July. Why is this bad for the stock market? Well, even though we got back-to-back negative GDP quarters, the last GDP quarter was negative 0.9%. The one before that was negative 1.6%. So it didn't get worse. It actually got a little better. Now, almost every single recession in the past, I think actually all but one, has been defined by negative back-to-back GDP quarters. However, with such a strong labor market, this is a rather weird recession if we are in one, depending on which of the definitions that you use. Now, officially, the National Bureau of Economic Research, which is a team of 8 economists, both conservative and liberal, are the ones that are responsible in this day and age for calling a recession, and they have not yet called this a recession. Now, regardless of what you think, the fact of the matter is this is why this is negative for the stock market, because it means the Fed has to remain aggressive. See, the Fed has been teetering back and forth between trying to fight inflation but save us from a recession. In order to fight inflation, you have to get aggressive with the interest rates and with quantitative tightening. In order to save a slowing down economy, you have to be a little more accommodative. That's why they were sort of playing both sides of the fence, not only with their language, but also with, some would argue, with some of their policies. Initiating 75 basis point rate hikes when some economists thought that they should have ripped the band-aid off and done a full basis point or a full percentage point, And then Jerome Powell came out last FOMC meeting saying that we are at neutral. We definitely are not at neutral. Nobody in their right mind thinks that, conservative or liberal. However, that was before the jobs report. Now that the jobs report came out, the Fed actually has no choice here. They have to raise. So while before the jobs report came out, nobody knew what would happen in the September meeting. There were talks of a pivot, meaning easing of monetary policy, not being aggressive with the rate hikes. Now, if you look at it, it's almost 68% priced in that the Fed is going to do a 75 to 100 basis point rate hike in September. This was due to the jobs report because this was a lot less before the jobs report came out. And obviously, this is negative for the stock market because the stock market does not like higher rates. Because the higher the rates, the higher the cost of money, the lower the value of earnings, and the more attractive other fixed assets look in comparison to risky stocks. So if you've been tracking my analysis on the markets, you'll know that we pointed out this fractal here on the S&P 500 that we saw back in February and March, after the first round of earnings during the beginning of the year. Somewhat decent earnings and somewhat decent guidance have led this bear market rally back to the same pattern that we saw before, and now is the moment of truth. The next CPI print comes out August 10th. The time of this recording is August 8th. So we will see what we're going to get in terms of inflation numbers. The expectation is that we get somewhere between 8.7% and 8.9% year over year. The last CPI report came out at a very hot 9.1%. If we get something significantly below expectations, then I think the market can actually break this and make new recent highs. However, if it comes in as expected or even worse than expected, then I could see the market actually making another leg down, potentially retesting in terms of the S&P 500, that 3,700 level again. Now, the S&P 500 made a more than 7% rise over the last 4 weeks. 8% would represent a 2 standard deviation move from the bottom on June 17th. Now, here's the very interesting data point that if you care about your portfolio and you care about your money, want to know. When the S&P 500 makes a 2 standard deviation move like this, what happens over the course of the next 12 months? Now, I'm going to go over this data with you, and this is probably the reason why I will likely hedge with puts over the next few months. Now, I might wait for the August 10th CPI numbers to come out, and August is historically the worst month during a midterm election year. And the fact that we are at resistance here, puts make sense if you have a lot of S&P 500 and or NASDAQ stocks in your portfolio that you want to protect and buy some insurance on. So when the S&P 500 makes a 2 standard deviation up move, the next 12 months is usually very positive, significantly positive. However, we do have some negative numbers in here. And those negative numbers usually coincide with what happened the previous 6 months before that move. Now, obviously, the S&P 500 has been in a bear market. If we look at 2001 and 2002, when the last 6 months, the S&P 500 has been down 9% or greater, we have had some double-digit losses for the next 6 months. On April 27, 2001, 6 months later, the S&P 500 was down almost 12%, and 12 months later was down almost 14%. And during August 16, 2002, when the S&P 500 for the previous 6 months was down almost 16%, the next 6 months, we had a minus 10% outcome. However, it's important to note that these are actually outliers. When the S&P 500 makes a 2 standard deviation move, the outcome 12 months later is usually positive, regardless of whether we had a negative or positive previous 6 months. As a matter of fact, the average, if the previous 6 months was negative, is still 14.5% for the next 12 months. So while buying protective puts here for the month of August might make sense just from a historical standpoint, and if you're looking for a little bit of insurance, this 2 standard deviation move is usually a good thing for the market. Now, one thing to note about the CPI release, during the last 4 CPI releases, the market actually went down either that same day and or the following day as well, and has usually rebounded a few days later once the information has been priced in. So buying protective puts in anticipation of the CPI release, as well as the fact that we're at a resistance level here on the SPY, makes sense. I might wait until the morning of the CPI before buying puts because I don't want to be eaten up by theta decay. I'm not sure yet. I will have to look at these trades with a closer eye before I send them out. If you want access to all of our trades, the daily watch list, the weekly stock market updates, you want to chat with thousands of traders, you want access to the Zoom calls and the masterminds with me, where I go over each and every question that you may have regarding technical analysis, option strategies, options trading, day trading, etc. Link is in the description below. Come apply and be a part of the academy. The general signups are closed. However, you can still click the link to apply. So schedule a call with one of our ambassadors if you are so inclined. Would love to have you. If you got anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think. Are we in a recession or not? Let me know if you think the CPI numbers are going to come in really hot or not. And let me know if you are buying protective puts or some other type of insurance. Would love to hear from you. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.